We're going to spend time understanding risk in more detail in this video. SEBI has really been focusing on ensuring that investors understand the risk that they take when they invest in mutual funds. And the first thing they've done for this is they've created what's called a riskometer, which you can see at the bottom of the slide. This riskometer has 6 levels, and the arrow points to the level of risk associated with the particular fund you are looking at. The 6 levels are low, low to moderate, moderate, moderately high, high, and very high. Let's understand these levels in a little more detail. Low is for risk-averse investors that don't want to lose money and they apply to shorter term investments. Low to moderate would apply to short to medium investments, maybe 1 to 3 years, and there is a nominal level of risk taken with these funds, and this is done so that you can get an adequate return. Moderate would apply to longer term investments. There is a little more risk taken to give you higher returns than the low to moderate category. Moderately high would again apply to longer term investments, and this would take even more risk to give you even higher returns. High would apply again to longer term investments, but the risk taken is much higher, and this is for those who don't mind taking some losses in the hope that they get even better returns. And very high would again apply to very long investments. The risk taken is very high, and significant losses are possible in the chance or in the expectation that significant gains are achieved. The potential risk class or PRC matrix is the second way that SEBI has mandated that investors be made aware of potential risk. The PRC matrix is only applicable to fixed income or debt funds. Fixed income or debt funds have two main risk components. The first is interest rate risk. This is the impact to the securities held in the fund when interest rates change. When interest rates go down, the bonds with higher interest rate levels become more attractive. When interest rates go up, the bonds with lower rates tend to lose value as they become more unattractive. Fund managers try and maximize gain by taking calls on which way interest rates are expected to move. The second risk factor that impacts fixed income or debt funds is credit risk. We discussed ratings previously, and when the rating of a bond goes up, so does its value. When a rating is dropped, the value trends downwards. Fund managers try and make profits on expected rises because of a rating to a bond. The PRC matrix aims to show investors the impact of both risk components to the fund. Interest rate risk is classified from 1 to 3, whereas credit risk is classified from A to C. A fund classified as A1 would have the lowest overall risk, whereas a fund classified as C3 would have the highest overall risk. The risk classification can vary based on the securities held in the portfolio. I hope you enjoyed this video. Do reach out to me at either the email address provided or the mobile number shared. The email address is adit@aditshah.in. The mobile number is 98675-87495. Do check out my website, which is www.aditshah.in. Links to my social media handles are available there. Please do follow me. Thanks for taking the time to watch this video.